David. Good afternoon. Let me see if I can get this to work.
Yeah, sorry,
It's all right, it's fine. First, I just wanted to introduce RFC Ambrian to those of you that don't know us. We're a leading resource-focused corporate advisory firm. We also do broker and nomad services for AIM-listed stocks and broker services for ASX-listed stocks. We're based in Sydney, Perth, and London. And what makes us different from our competition is that many of our staff, or in fact the majority of our professionals, have a technical background and come from industry. So for the geologists and engineers out there, we speak your language. This is the point where I have to confess that I'm not one of those technical people. I am a lapsed chemist, unfortunately. I come at it from a financial point of view. I did my training at Arthur Andersen when it was still going, and then did an MBA at Kellogg Graduate School of Management in Chicago. I started off as an oil and gas analyst at Credit Suisse. I was the Russian oil and gas analyst there from 94 to 98, so I led the IPOs of both Gazprom and Lukoil. And then when Russia collapsed in 98, I moved on to cover slightly more stable companies like BP and Royal Dutch Shell. I then moved on up into become a head of research at ING and UniCredit, and was very happy 2 years ago to leave all that behind and go back to my tools and join RFC Ambrian to cover small and mid-cap companies. As David said, we published a report at the beginning of March. If you'd like to get a copy of it, it's a bit long, so I'll just send you the PDF if that's possible. Give me your card throughout the day. Let's see. So why are we excited about Sub-Saharan exploration? We think that equity markets really don't understand the potential in Sub-Saharan Africa. They don't get the scope for new oil and gas discoveries there. Current levels of production of oil and gas negatively affect perceptions about what's left to find on the continent. But it's not the current level of production or reserves that determines what's left to find. It's the propensity of the rocks to form oil and gas fields and how much historical exploration has gone on beforehand. And it's on this latter point where Sub-Saharan Africa wins out, because there's been very little exploration outside of Angola and Nigeria. It's the surface issues that our previous speaker was referring to. Those obviously caused much of this lack of exploration, but it means the region has not been explored to its geologic potential. According to the USGS, sub-Saharan undiscovered oil resources make up about 19% of undiscovered global oil resources. That's quite a huge number. That puts it in line with the undiscovered resources in North America, the undiscovered resources of Latin America, and not far behind the Middle East and North Africa. So we also identified 5 plays similar to Duncan. My geologic experience meant that I put 2 of them together and called it Africa Atlantic Margin. But I've just listed here the main companies that are following these different types of plays. We've also included Namibia because we think it's exciting, but there hasn't been a commercial success in Namibia just yet. On the next few slides, I'll take you through each of these plays separately. Let's do that. So along the West African Transform Margin and up across the north-west Atlantic Margin, many companies are trying to find late Cretaceous fan plays. The poster child for this was the Jubilee Field. It was discovered in 2007 by Tullow and Cosmos. It has about P50 reserves of 700 million barrels of oil, so it's a giant field. Adjacent to it is the 10 project that has 360 million barrels of oil equivalent, or about 250 million barrels of liquids in it. That's at sanction and should reach production late 2016. Also in the Tano Basin, Hess has made some significant discoveries deeper offshore. However, outside of the Tano Basin, the record is really not so good. There have been about 20 wells drilled since 2007, chasing this play along Africa's Atlantic Margin and over in French Guiana. None of these wells have had a commercial success to date. There have been a few technical successes where they've found small reservoirs, but no commercial successes. What's happened is that wells that have penetrated thick sands have generally just had oil shows, whilst those that have found oil have found them in thinly bedded reservoirs. I think part of the problem is that the Jubilee Trap initially wasn't well understood by industry. It's a combination stratigraphic structural trap, and the up-dip fault makes an important part of the trap. Many of the wells that have been drilled since then have just been stratigraphic traps, and they haven't been as successful. The faults are also important because they're thought to be syn depositional, and that means that as the sand was deposited over the down-thrown fault, it became very thick, and that's what caused the Jubilee to be a giant field. So I think there are a number of wells going to be drilled over the next few years trying to chase this play again, but industry enthusiasm for it has clearly diminished over the last 2 or 3 years. I think one of the more exciting plays has been the West African pre-salt play. Cobalt has been the leader here. It's had 5 discoveries in blocks 20 and 21 offshore Angola, and they're pretty sizable discoveries, as you can see. Probably 2 of them might not be commercial because they didn't get a sustained flow rate from Avinga, and Lontra has got so much gas in it, they've got to work out what they can do with the gas to get the condensate out the ground. But even so, that's a pretty good return for 5 exploration wells. In Gabon, I would say the jury is still out. Total's Diamond 1B well, which is, if I can point to it, is about there, found a gas condensate discovery that's thought not to be commercial. And Ophir's recent Paddock well, deep well, which was up there, was dry. Ophir will drill another well this year. It'll drill the Okala well, and we'll have to await the results of that before we write it off properly. But it's certainly not working just yet. But one area that is working very well is the East African Rift Basin. Tullow has led the way in Uganda. Tullow made the first discovery in 2006, 2007. Soon after, it bought out Hardman Resources, and then it bought out Heritage Oil and Gas to gain full control of the Lake Albert Basin. Subsequently, it sold down a 2/3 interest to Total and CNOOC for $2.9 billion. More recently, it's been a bit slow progress, largely because the Ugandan government was insisting on a very large refinery being built alongside the development plan. They now seem to come to a memorandum of understanding that it'll be a small refinery, and that project is meant to go to sanction in 2015 with first oil in 2018. Tullow estimates there's about 1.7 billion barrels of recoverable oil in the Lake Albert Basin. Tullow's also leading the way in Kenya, and although this only shows 4 discoveries, they've actually had 7 discoveries in the South Lokichar Basin. There's over 600 million barrels of recoverable resources according to Tullow. If you look at Africa Oil CPR, it would actually say 1.3 billion barrels, so you've got to be a little bit careful about the numbers you use, but nonetheless, it's clearly at a commercial level now. Project sanction is due 2015-16, again with first oil in 2018 and 19. I think both these projects will actually go on the same timetable because they're meant to share the same infrastructure, which is the LAPSAT pipeline from Uganda through South Kerio Basin, through the South Lokichar Basin to the port of Lamu. The rift basins, extend all the way down East Africa, into Rwanda, Burundi, Tanzania, Malawi, Mozambique, and they also extend west into the DRC and Zambia. Many of these basins have had pretty much no or very little exploration so far, so there's plenty of potential for finding a new basin. But just because it's worked in 2 basins doesn't mean it's going to work in all of them. This year, Tullow, I think, is going to test 3 more basins. It's going to test the Chuba Hir Basin in Ethiopia, the Turkana Basin in Kenya, and the South Kerio Basin, which just happens to be next door to the South Lokichar Basin. So there's going to be plenty more news, I think, from this play over the next couple of years. And then offshore East Africa, it's all gone a little bit more quiet recently because the big discoveries were made a while ago, but Anadarko opened up a world-class gas basin in 2010 with the Windjammer discovery in Area 1 Mozambique, which is, go back, which is just about there. Now, between Area 1 and Area 4, there's something like 60 to 120 TCF of recoverable resources, and they're planning a joint LNG facilities that will include about 10 trains. So it's a pretty huge project. First gas plan 2018, I think that's probably a bit aggressive, but nonetheless, that's what they're saying. To the north, you've got BG and Ophir and Exxon and Statoil. They have blocks 1, 3, and 4 and Exxon Satellite Block 2. Between them, they probably have about 30 TCF of recoverable gas. So they've probably got 4 trains of LNG in the south of Tanzania. And they're continuing to do exploration this year. Further north, people are chasing oil up in Kenya. BG's Sunbird prospect was found to have oil and gas, although it is not clear exactly how much oil or how much gas they have, and certainly doesn't seem to be commercial. So we'll have to await further news from that before we can see that that's going to be a success. And then Namibia. So we got excited about Namibia when we saw the results from 2 HRT wells, which is the Wingat well and the Marumbi well. The important thing was they found 2 well-developed oil-mature marine source rocks, and in the Wingat well they recovered 41 degrees API oil to surface from thinly bedded sand reservoirs adjacent to the source rocks. Tullow also clearly believes that the basin has been de-risked given the terms of the farm it agreed with PanCom. Prior to the HRT wells, the farming multiples of 2 previous farmings were between $2,500 a kilometre squared and $3,000 a kilometre squared. But Tullow agreed to carry out to a work programme that was equivalent to about $11,500 per kilometre squared. So Tullow clearly believes that its licences are de-risked by these 2 wells, and these are Tullow's licences here. The news this year will come from the Welwitschia well, which is a Repsol Tower well, and I believe the rig is on site and should spud in the next couple of weeks. It's a huge prospect, so if it comes in, it'll be enormous for both, well, mainly for Tower, but it'll also be quite big for Repsol. However, I think it's quite a high-risk well because from what I've seen of the source rock maturity, it involves a pretty long migration pathway to get from where the rocks are mature to get to where that well is. So I wanted to start showing a few share price graphs to see what the equity markets have been doing, and I wanted to start off with a success. And the success I chose was Africa Oil Corps. This is the share price since early 2012. And you can see that after the first discovery, the market pretty much priced in the value of the whole basin. So the Ngamia well, pre-drill, was I think a 55 million barrel prospect. So net to Africa Oil, it was about 25 million or 28 million barrels. So 2 months after the discovery was announced, Africa Oil had a market cap of about $2 billion, and it had contingent resources of about 30 million barrels. So the market was clearly placing a bet that this company would find another 1 billion barrels, pretty much. As it turns out, that's exactly more or less what has happened, but it certainly didn't seem to me that at that time that the market was pricing in the risk that it wouldn't happen. What I've done on this graph is I've put in the 7 Lokichar Basin oil discoveries, and I put in a few of the wells that have been P&A'd because they weren't commercial, and I put in the 2 flow test results there. But it wasn't until here, when they announced their 6th and 7th discovery, that Tullow said they had sufficient resources for development. So everything up to here was pretty risky. And that's what the markets do. If I showed you a graph of Cobalt, it would look pretty much the same. If you did it before the Camea well came in, the share price went up 4 or 5-fold on the back of the Camea well, and it's gone sideways to down ever since. So it was pricing in pretty much the whole play off the one well. Unfortunately, for most of the companies that we look at, that hasn't been the story. On the left here, we've got the mid-caps. And so while some of them have outperformed since the beginning of 2012, if you took a starting point, 3 or 4 months later, many of them would have gone down. The only real winner is Afrin here, and that's not on the back of exploration discovery, that's more on the back of increasing production out of Nigeria and getting Kurdistan to work. And if you think the share prices of here are not that impressive, look on the right here where you've got some of the junior companies in this space. Only one of these companies has a share price above its January 2012 level. I think there are a couple of reasons why exploration is so out of favour. The first is we haven't had a whole lot of success in the last 2 years. And for exploration companies, you need success of, even if it's not your company, of another company, so that investors can take profits from that other company and invest it in the next story, which would hopefully be your stock. The other thing I think that's going on is a lot of capital is being sucked into US shale, gas and liquid plays. Even some of the large independents, I mean, a big one like Anadarko that's had one of the most successful exploration programs offshore Africa, cut back its capex that it's spending internationally from 25% in 2011 to just 15% last year. And all this capital is being sucked into these US shale plays. And if you look at a lot of the US shale players, they don't have positive free cash flow yet. They might be growing production quite dramatically, but they're sucking in capital from the rest of the world. And that's hurting the share prices of some of these companies. So on this slide, I wanted to show that the industry is paying more for assets than equity markets. So what I've done here is I've put the licenses of 3 AIM-listed stocks, and I've valued them based on industry farm-in multiples. Where the license is highlighted in yellow, I've used the actual terms of the farm-in onto that license. Where they're in white, I've used an average industry multiple of farm-ins in nearby basins. As you can see, let's go back. Chariot's trading at something like a 70% discount to the industry farm-in multiple, as is Global Petroleum. Only Fastnet is trading close to it, and even it's at a 13% discount. So there's a dramatic discontinuity between what the industry is willing to pay for a license and what the equity markets are willing to pay for a license. And it's not just on AIM. On the next slide, I've got 3 ASX-listed stocks. Okay, FAR is trading at roughly the industry multiples, but Pan Continental is trading at a 70% discount, and WHL is trading at a 52% discount on an undiluted basis. On a fully diluted basis, it's more like a 16% discount. The reason why both FAR and Fastnet don't have the same discounts that these other stocks do is because in the case of Fastnet, they're currently drilling the FA1 well in Morocco along with Cosmos and BP. And for FAR, the Cajun Express, which is Cairns rig, is moving down to Senegal to spud a well on FAR's acreage in Senegal as we speak. So basically what happens is that the equity markets are quite willing to use industry farming multiples when there's drilling going on, but if you haven't got a drilling catalyst, then you're going to get a pretty significant discount to what the industry is doing until you get that catalyst. So I just wanted to walk you through how I and most sell-side analysts and also most buy-side analysts try and value companies. We do it on a risk net asset value, and I thought it would be interesting just to show you what we do. So first of all, we start with either the 2P reserves or 2C resources, and we work out what the gross resources are. We take the company's net interest in those resources. We build a development model for the project and come to an NPV per BOE, and in my case I use the forward curve for Brent and a nominal 10% discount rate. That gives you an unrisked value for those fields. And we then risk it in 2 ways. First of all, the chance of geologic success, which if it's a discovered resource or 2P reserves is 100%, and then the chance of commercialization. And you have to be quite careful about these chances of commercialization because they can be quite low for small fields. We also then value the work program. So generally I go a year ahead. Some people go 18 months ahead. Some people go maybe 6 months, but a year looks about right to me. And we do exactly the same, which is you work out the value of the prospect unrisked, and then you risk it by the chance of success of the well, by the chance of commercialization. So as you can see in the case of Senegal, this first well, unrisked it's 1 billion barrels to FAR, but risk we've only put in $100 million for it. I also do a little valuation of follow-on prospects. This is trying to give the option value of similar plays just in case one of these work program wells works, but I risk them very heavily. So this one's being risked at 1% of the value. Some companies have licenses where we don't have prospect information. So in that case, we value the licenses based on farming multiples. We don't use N2013 cash. What we do is, as we've taken the value of the work program up here, we subtract off the G&A and the exploration costs for this year to basically forecast N2014 cash. And that gives you an NAV per share, and this is for FAR Limited. If you do that for the 10 stocks that I cover, you get the following slide. And what I've done here is I've split out, I've plotted the share price the fair value as a percentage of the share price, And I've split out the proportion from each of the different types of different types of factors. So the dark blue is cash. In the case of Tullow, it has 1.9 billion of net debt. And you've got Tullow's reserves and contingent resources. And then you've got Tullow's work programme. I've done the same for Ophir and Africa Oil. And these prices were as of last week. So Tullow and Africa Oil are pretty much holds, given where we think they should trade. Ophir still looks to be reasonably good value. In fact, it's trading below what is commonly determined as core value. So basically, it's trading below the value of its Tanzania's blocks 1, 3, and 4 assets, valued at the price that Pavilion played for 20% of those assets, plus its cash. So the market's betting that its exploration program is going to destroy value at the moment. That's how bad it is. The junior companies have even more upside than Ophir, and that's, I think, partly because we don't take an explicit account of funding risk, and there's no doubt equity markets are pretty tough for junior oil and gas companies at the moment, and therefore you might want to take 15 to 20% off of these numbers to take account of that funding risk. But as you can see, FAR is very heavily exposed to the two Senegalese wells. If they come in, it could make an enormous difference to its share price. If they don't, then the share price will react negatively. That's it.
Okay. Right. Any questions, please? Nobody? Yeah. Oh yeah. Hi, Alex.
Yeah, you were talking about Cobalt, and I was just wondering, in terms of clearly, in terms of the announcements, their share price has done well. But in my presentation, I did mention that they had also become under investigation.
Sure.
Does that actually impact the share price, or does the market completely ignore that and just go on?
The day it was announced in the FT, the share price went down about 5 or 6%, if I remember rightly. So the market does take some account of it, but I think it takes it in its stride.
Just to give you another example, I think you could see Tullow declared force majeure in Guinea over hyperdynamics investigation by the Department of Justice and the SEC. And I think hyperdynamics share price
60–70%.
dropped by that sort of number. So it depends, I think.
It depends.
Yeah. Okay. Anybody else? Right, okay. Thank you, Stuart. Thank you very much.